Our next guest steered the Irish Pension Reserve Fund through a series of strategic pivots dictated by the changing economic backdrop facing the country over the past decade. Find out what it taught him about flexibility, resilience, getting points on the board early, and going with the flow. I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Eugene O'Callaghan, who is a business and investment advisor based in Dublin, where he advises a range of asset managers and sovereign wealth funds on strategic initiatives. He was formerly director of the Irish Strategic Investment Fund, and prior to that, director of the National Pensions Reserve Fund of Ireland. He started his career as an accountant. Welcome, Eugene. Thanks for joining me today.
Thanks, Ethan. Delighted to be on.
Well, let's start with your background and career journey. Where did you grow up? What did you study? And how did you come to enter the world of finance?
I lived in a few different places in Ireland in my youth. I was born in Limerick. I lived in Rosscray in the Midlands for a few years, and my family moved to Waterford when I was about 11 years of age, and my mum still lives there, so that's sort of where I consider my home. After secondary school there, I went to UCD, pretty traditional, did a BCom. I ended up working for KPMG in Dublin, and then after I qualified as an accountant, I went to work in Wellington in New Zealand with KPMG. So that was very traditional accounting journey. After a couple of years with KPMG in Wellington, I moved to an investment bank, DFC, and that investment bank was active at a time when the New Zealand economy was suddenly deregulated. So there were fantastic opportunities there, fantastic experiences. But after a few years, I went out with my wife, Una, and after a few years, we decided to come back to Ireland. So family and personal reasons, which was fine. So I ended up working for a short time for KPMG in the corporate finance area. And then I joined Irish Life Investment Managers to run their unlisted portfolio private markets investments. So that sort of got me into investment in the first place. And I worked in Irish Life Investment Managers in a variety of roles for about 15 years. And then in 2005, I joined the National Pensions Reserve Fund team to look after the portfolio of listed market managers, equities, bonds, hedge funds, commodities, whatever the NPRF was investing in liquid markets. And in 2010, my predecessor as head of the fund, who was my boss then, John Corrigan, he was promoted, became the head of the overall National Treasury Management Agency, and I became head of the National Pensions Reserve Fund in 2010. And that then morphed following the financial crisis, as I'm sure we'll discuss, into the Ireland Strategic Investment Fund in 2014. And so I was head of the combined NPRF ISIF for 11 years, and I stepped down from that role in 2021.
Well, we've a host of things to ask about, certainly in relation to the Irish Strategic Investment Fund and beyond. But I always ask usually about surprising turns. And that move to Wellington, maybe it could be seen as an adventurous move or a surprising turn. Could I just ask what drove that? And given that the New Zealand economy is sometimes compared to Ireland's in terms of certainly population size, were there any kind of takeaways from there that you brought back home?
Well, I would say it was driven really by just a desire. This was the 1980s to live in a different part of the world, and I was a bit lazy, didn't want to learn a different language, so it was somewhere English speaking. And Una and I wanted to live somewhere where we would be living the life of the ordinary people, not as expatriates, which there was a lot of expatriate migration in the KPMG network at the time. So we ended up, I got an offer from New Zealand, so we just ended up for that reason in Wellington. And it was a fantastic number of years and a really important life experience for both of us. In terms of the takeaways, it's a very similar country to Ireland in many respects, as you have described. I would say in a business sense, the main takeaway is the people are more entrepreneurial, or certainly they were then. There was a culture of nothing in New Zealand was more than 100 years old at that point, but it was very recently settled country, and people had to be entrepreneurial and enterprising. And you could see that coming through everywhere, which was quite different from Ireland, where people were much more focused on security and jobs in large organizations. That was back then. I think Ireland has become much more entrepreneurial since then, but maybe that was the appreciation of the need for an entrepreneurial spirit in society was maybe one of the biggest sort of business-related takeaways.
Really interesting. And of course, the ability to relocate like that is a true advantage of one of those global firms with a presence everywhere. So I think certainly something for any aspiring corporate finance careerist to bear in mind. So one of the things that really struck me about your time at the National Pension Reserve Fund is that you presided over a phase of tremendous growth, followed by regime change that was driven by the financial crisis. I've used the phrase making lemonade out of lemons because I see that you pivoted the investment program there according to the new strategic imperative of the Irish government at the time, some of it driven by the frailty of the financial institutions. This happened again then after the pandemic, and there was a need to pivot the investment program a second time. Can you talk about some of those pivots and what you learned from them?
Sure, and the Irish Sovereign Wealth Fund, the National Pensions Reserve Fund, which became the Ireland Strategic Investment Fund, has been through a number of different identities and strategies, even in 20 years since it was formed in 2001, which is only 20 years ago. And for the period from 2001 out to 2010, the National Pensions Reserve Fund was a classic sovereign wealth fund investing. It was funded, and seemed amazing now, but 0.25% of GNP got put into the fund every quarter. So every 3 months there would be a check for 0.25% of GNP. 1% of GNP was injected every year, and the fund grew quite quickly. And obviously, certainly before the financial crisis, markets were quite good in the 2000s, the first 10 years of the decade. And so it was a very traditional sovereign wealth fund and investing globally and, pretty good, I think, at what we did. So then the financial crisis came, and as would be well known, it hit Ireland particularly badly, a huge real estate driven conventional financial crisis, as opposed to some of the more esoteric derivatives which caused some of the problems in the wider financial sector globally. But ultimately, as you've mentioned, the Irish banking system needed to be recapitalised, needed to be bailed out by government, and the country as a whole, tax revenues fell off a cliff. And as a country, we entered into a programme with the IMF, the European Union and the European Central Bank, who provided there was an 85 billion euros liquidity programme, which was to support the Irish economy through the crisis. But of that 85 billion, 17.5 billion was to come from Ireland. And the bulk of that came from the National Pensions Reserve Fund. And effectively, the fund at its peak was 23 or 24 billion. And ultimately, between that 17.5 billion and some other calls on the money, over 20 billion of the fund was liquidated over the years 2010, 2011 in order to provide money to recapitalise the Irish banks. So the fund became the legal owner of very substantial stakes in both Allied Irish Banks and Bank of Ireland. And that was a massive liquidation by any global standards. It was a massive liquidation of assets at that time. So the fund was much smaller. The country was working out how to deal with the financial crisis. There was a new government in 2011 who identified that they might like the National Pensions Reserve Fund, what was left, 4 or 5 billion euros, to convert into a strategic investment bank. And ultimately, there were a lot of serious problems. We weren't at the top of the government's priority list. In 2013, that morphed into the idea of a strategic investment fund with a mandate to invest on a commercial basis to support economic activity and employment in Ireland, which was very appropriate mandate for the country at the time. And it took until 2014, the end of 2014, for the relevant legislation to be enacted and the fund to be the Ireland Strategic Investment Fund to be kicked off. So then from 2014 onwards, we were effectively investing in the Irish economy. So gradually the global assets that were remaining in the 4 or 5 billion were liquidated as needed to invest in the Irish economy. But obviously that was a multi-year investment programme and is still ongoing. What happened then was that the Irish economy rebounded from the financial crisis much faster than people had expected. And so the ISIF had to amend its strategy. Essentially, the owner of the money, the government, the Minister for Finance, were concerned by 2018 and into 2019 when the strategy was amended that ISIF's money would not be part of overheating the economy. So in sort of 4 or 5 years, gone from trying to rejuvenate the economy to one of being worried about overheating the economy was a pretty quick transformation. So the ISIF strategy was adapted. ISIF 2.0, we called it. There were a number of themes which were expected to be very long term, which could do with capital, but which were not nearly as general as the original ISIF strategy. So these themes were around regional development, around housing, around supporting indigenous companies, and around climate change, which are themes which the Irish economy will need to deal with. It's a multi-decade requirement in those areas. So that was an evolution of strategy. And then in 2020, again, the pandemic hit and the strategy pivoted again. So a sub-portfolio of the ISIF was set up called the Pandemic Stabilisation and Recovery Fund, which was targeting investment in medium and larger businesses, which did have a long-term future, but which had been negatively impacted by the pandemic, to provide capital to help bridge the period until the number of years until normalisation might return. So again, that was a variation on the strategy. And so I suppose what I've learned from that is that for a sovereign fund, a sovereign development fund, flexibility on strategy is really important, because with the best will in the world, the needs of countries change, and there were significant needs which drove those changes in strategy as we went along. But what was really important was that the fund, rather than setting up new funds or new agencies or whatever, the fund was able to adapt its strategy, but within the existing legal and governance framework, and indeed within the existing general mandate. And so that flexibility meant that strategy adaptations could be implemented way faster than if, new organizations needed to be set up. So I would say flexibility on strategy was by far the biggest lesson in the context of a consistent framework of mandate and governance, which was unchanged throughout. I think as well, the other important lesson for a team managing a sovereign fund is around the need to ensure alignment with government policy, which goes without saying. But at the same time, it means the team has got to be willing to go with the flow a little bit and can't be resisting change, because this is what we've always done in a sense, but has to accept that the needs of the nation do change through such periods. And one other learning, which is sort of maybe more specific to the ISIF, but that what we found was that the ISIF became a very effective link in the investment sector between the public side, government and government agencies and government departments, and the private sector investors, banks, financiers, private equity investors, infrastructure investors, because ultimately we were a public entity responsible to government. So the public side of the pitch, if you like, trusted us. But we were a private markets investor, and we would always work to have co-investors alongside us. So the private sector players could see that we were speaking the same language and had the same commercial investment objectives. And so ultimately, another learning was the key role that a commercially oriented sovereign fund can play in bridging the gap between public sector participants and private sector participants in the investment arena in a country.
Really fascinating. I hadn't appreciated just how much the fortunes of the Strategic Investment Fund and the Pension Reserve Fund mapped Ireland's own economic history over the last, say, 12 years. And just looking at how you pivoted, we can actually trace how some of the challenges the economy faced. And of course, great takeaways for work you do with other sovereign wealth funds around the world now. Just wanted to follow up on a couple of the points. Firstly, regarding this alliance with some of the private sector players. And given the size of the Irish economy, what would be some of the challenges maybe in attracting private investment? Is there a question of, is there a minimum size perhaps that some international private sector groups would need to have? Or perhaps it's some of the investment size is too small that it doesn't reach their minimum criteria. Are there other challenges and opportunities that you've seen on the Irish investment landscape through this work?
Yeah, there was definitely a subset of the international investment community who would only write minimum check sizes of 100 million or 200 million euros or dollars or whatever. And typically those check sizes to be part of a transaction in Ireland were then too big and they weren't going to. So if parties that we interacted with had that issue, they would ultimately not end up being co-investment partners or investors that we would end up working with. So they would be organizations we would keep in touch with over time and so on. But we probably ended up working with the next tier down size-wise and or some of the large international players who understood the size of the Irish economy and were willing to write a smaller check size given the attractions of the rebounding Irish economy, which was very strong economic growth. And a lot of US parties in particular, investors could see Ireland was a country with high economic growth and that wasn't necessarily easily achievable elsewhere in the Europe of the 2010s. And so they would compromise their normal investment size to get access to that growth and see where that might bring them. But it wasn't a huge issue. Ultimately, all of the investment partners, there was no program. They ended up arriving on a case-by-case basis, and there was quite a lot of ad hoc and who would be the right party for a particular transaction. But there wasn't a comprehensive program, and Ireland is probably too small for somebody to allocate €1 billion or dollars in anything, because you might get a transaction once in a blue moon or you might not. So those types of investors really needed to look elsewhere.
It's interesting. We talked earlier about the entrepreneurial enterprising culture in New Zealand and how maybe at the time, the 1980s, that was different from the culture that prevailed in Ireland. Now that you're looking at the opportunity set and have been looking at it for the last decade here in Ireland, what would you say has changed in terms of the culture, maybe the sectors that present the most opportunity?
I would say in culture, maybe at a very basic level, the biggest change that I've seen over the last 20 years has been the acceptance by most Irish businesses that equity is a good thing. Whereas for a long time in Ireland, equity was regarded as blood and people would never concede equity in their business and they would borrow as much as they could from the bank, and banks ended up taking equity type risks because they were trying to maintain market share. Because that really happened in the real estate sector. That's what drove the crash and the problems that the banking system in Ireland had in the first years of this century. So I would say there's been an acceptance that equity investment is good and that equity investors don't want to take somebody's company away from them. They actually want to invest in the entrepreneur and don't want control, which was the sort of original mindset. So I'd say this acceptance of equity. I would say then as well, the entrepreneurial spirit is really apparent in the technology sector, in the earlier stage businesses, and the ecosystem in Ireland that has been built up over the last 20 years, plus or minus. Contributions from, I think, Enterprise Ireland were very strong in getting this kicked off. A number of venture capital funds and more have come to operate in Ireland, and they all bring global connections and a global network and linkages into Silicon Valley and linkages into marketplaces and linkages to networks of expertise. And so that has all of that whole ecosystem has matured significantly and has therefore supported the entrepreneurs who have been there. And then some of them have been successful, and that has inspired others to give it a go. And so compared to 25 years ago, certainly in the technology sector, the entrepreneurial spirit is way more prevalent than it was then. More generally in the economy, I think I've seen quite a lot of the same then in sectors which are export oriented, businesses which are competing for clients and customers in overseas markets where you clearly have to be international standard. And some fantastic examples of indigenous companies which have raised equity from private equity investors. They have got past the equity is blood mentality, raised equity, which is given capital to grow the business. And they've done that with an energy and a quality that's been really impressive. And so it seems to me that parts of the Irish economy that are now outward looking, and we have a very international facing economy, parts that are facing outwards are in very good shape. The question marks still are around maybe the more domestic oriented service sectors where there's not the same exposure to international competition. Though, even that's beginning to change now with the new world of online retail and all this sort of stuff. That's beginning to change as well. So I think all of that has happened over the last 20 years and has been very positive.
Well, of course, a massive change that you mentioned already was the incorporation of sustainability principles in your investing. Maybe this comes from the nexus that the institution would always have had with policymakers and be seen as a first call in terms of implementing policy and really setting the standard around sustainability. Can you talk a little bit about the work in that area, given the strong focus that the Pension Reserve Fund has always had in sustainability?
Yeah, I think sustainability inherently is a concept which is consistent with being a long-term investor and with the long-term perspective. And if you're a long-term investor, you've clearly got to be worried about the sustainability of the investments in your portfolio. So there's a sort of an inherent logic, which means that sustainability is really important. And as we know, it's only in the 2000s that asset owners began to think about sustainability very much at all. The National Pensions Reserve Fund was a founder signatory for the Principles for Responsible Investment in 2006. And that was driven by, on the one hand, thinking about sustainability, but also the need as a sovereign fund to have a framework that was internationally acceptable as good or best practice for dealing with how do we decide what investments were appropriate to be included in a fund or not, and the whole concepts of environmental, social and governance factors, which are embedded in the PRI. That became a framework for being able to respond to stakeholders' interests in what the NPRF was investing in. And these could be politicians, but they were often NGOs or members of the public. And so there was clearly a need as a public fund for a framework to help rationalize what was in the fund, what wasn't, and what approach we took in relation to potentially controversial issues on the ESG front.
And let's stay on some of those issues now, because we also touched on culture earlier and some of the, both on the investment side of things and the business culture, but also the pivots that you had to make and the flexibility that you had to show at the fund. And I'm curious as to how that affected maybe retention of personnel and the morale of personnel, certainly when we saw that initial contraction of assets in the aftermath of the financial crisis. Talk a little bit about how, in a public entity like that, how you retain top investment talent, how you attract it, given that it is traditionally harder to compete with the private sector. And maybe we can talk also a little bit about diversity across the sector too.
Okay. So I suppose the biggest pivot in the fund in terms of the impact on the team was when the National Pensions Reserve Fund morphed into the Ireland Strategic Investment Fund. And people who had been global investors would have a very different perspective from the private investment, corporate finance perspective that would be needed for investing in private markets opportunities in Ireland in both debt and equity. So what happened at the time actually was that the NPRF team, about half of the team decided they wanted to stay in public markets, more global investment. They wanted to stay in that world. So what we did was we had very open conversations, and anybody who preferred to stay in public markets and not to commit to the ISIF agenda, we helped them exit with introductions. One or two of them decided at the time of life they would go and live in London and things like that. So we used our network of investment managers and contacts and asked people to introduce our staff members to other people who they thought might have openings. So ultimately, we helped and eased the way for people who didn't really want to commit to the pivot to private markets investment. Then in terms of building up the team, the National Treasury Management Agency, which is the umbrella agency for the NPRF and also then the ISIF, was set up outside of the civil service structures, even though it's a public agency managing public assets and liabilities, but was set up outside the civil service framework in order not to be restricted to civil service pay scales. So while there are always budgetary issues and budgetary difficulties, pay levels have over time have always been reasonably comparable with private market equivalents. And even though it's been a struggle at times to maintain that. So it's not as if the pay is terrible, but the pay was reasonable. And then what I always tried to focus on in building a team was to create an environment where any talented individuals, they could spend 80 or 90% of their time doing what they enjoyed and what they were good at. And that married then all of the team would always have had a sense of purpose and public good from being involved in a sovereign wealth fund. And so you're combining that sense of public good with an opportunity to do things. And part of what I tried to do, and it's always a bit of a struggle, was to keep the processes and the wheels oiled internally so that the team could focus most of their time on pure investment issues. And so it's a combination then of reasonable pay, a good team environment, and a great sense of purpose attaching to the fund mandate. That's ultimately the combination that I used to try to build a team.
Definitely purpose has to be part of the equation. And I think that probably a lot more should be made of that actually in the public fund arena, because it is a very strong driving force, especially as you're so involved in the sustainability area. It's a great way to achieve that with scale. On your thoughts on diversity in the industry, you've been in the industry for some decades now. Have you witnessed any changes, any observations, just given this podcast that we do touch on diversity a lot of the time?
Mm-hmm. Yeah, I think the investment management industry, definitely the diversity agenda has improved compared to 20 or even 10 years ago, but still quite a way to go, I would say, and not just in gender diversity, but in terms of reflecting the breadth of the backgrounds of people who live in our society. That's not nearly represented enough, I would think, in the investment sector in general. I think there's probably gender diversity, there's probably good diversity at board level now. And there's very strong diversity, as we know, at entrant, junior to middle level team members. At senior levels, I've been trying to get to a level of 30% female in senior levels, and it's slow to get to that level. I think that's, maybe a reasonable first target. But part of the issue, which isn't really talked about, is I would have had experience over the last number of years when recruiting for senior investment personnel. 90% of the applications typically came from males. So to drive up female participation at senior levels when the number of applications is so skewed is obviously difficult. And of course, that battle has to carry on. I think it might be worth some analysis, and I don't know what the answer is, as to why that gender skew exists, but it's been very noticeable for quite a number of years. I think then in terms of wider diversity, and there's obviously a lot of different nationalities and people with different national backgrounds living in Ireland, which is quite new to us compared to the 1990s and before. We were a hugely homogenous society. I think the metrics that have been applied to gender diversity probably need to be applied more widely in terms of whether it's ethnic backgrounds or diversity in relation to the types and backgrounds of people who are working in teams, because clearly diversity it's a bit like an investment in general. I always think diversification is the only free lunch. It's the only way you can improve your outcome, but no real cost. And that certainly goes for team construct as well.
Very true. And you're certainly not the only one to have some frustration and I suppose consternation around that problem in the applicant pool, which I think we'll all do our best to address, but I think it needs to come from many different directions. So let's just go back to some personal reflections now. So over the course of your career, you're now on to the next chapter. What would you say were some of the highs and lows so far?
I would say in terms of the highs, 2 or 3 things that I really enjoyed and then went well. I think working in New Zealand in the beginning in the 1980s, which was sort of fortunately landed in the investment banking world right at the time that the economy was totally deregulated overnight. So there was huge opportunity and it was all new. And so I was a young guy then, but there were no people 10 and 20 years older than me who had done this before. So the opportunity was there. So landing in a suddenly deregulated environment at a formative time of my career was a fantastic opportunity. And I think probably the biggest high has been in the ISIF more recently in terms of building a fund from scratch. When we started out in 2014 with a mandate to invest both commercially and to support economic activity and employment in Ireland, there was no real precedent for that. There's no textbooks written on sovereign development funds. Whether it could work or not was highly uncertain. And so building ISIF from scratch and into an established entity, and that is definitely delivering both commercial returns and economic impact in Ireland, that has been ultimately the high. And then probably underneath the covers, I've had a couple of teams that I have worked with developing, one in Irish Life Investment Managers back over 20 years ago, 30 years ago now, and the ISIF team, where there's been, again, a sort of a team developed from nothing. And I've really enjoyed working with the individuals that came together and the common sense of purpose and energy that's been brought to bear. So they've probably been some of the high points. Some of the lows, I wouldn't say they were so much lows as challenges. I've never had a low that caused me to, thankfully, get depressed about what I was doing or anything like that. I think some of the challenges have been, given I am a pretty strong team player, dealing with talented individualists who are totally not team players. I've always found that very challenging. And the challenge as well in the sovereign, in the ISIF as a sovereign development fund, I've referenced this earlier on, the umbrella organisation, the NTMA, was a public body dealing with huge amounts of public money and public resources, and by necessity needs to be cautious and is answerable to the people of Ireland, obviously, and aligning that caution with the need for entrepreneurial investment in a sovereign development fund, in private equity, private debt situations, and keeping at the pace of the market transactions. That has been challenging, and it's got more challenging as time has gone on. I would have to say it's easier in the startup phase, but it's got more difficult as time went on. And I suppose the other negative, which was totally a one-off, but there was criminal activity in State Street in 2011, where the NPRF and 4 or 5 other large pension funds globally, there was effectively money taken by the State Street profit and loss account, which belonged to those clients in the transition management area. And, I was directly responsible for that. There was criminal activity within State Street. People were subsequently convicted, and none of the State Street internal controls picked up this. There was collusion involved. But the whole dealing with absolutely relevant inquiries, audits, the Public Accounts Committee of the Irish Parliament, and then involved, there were police investigations. We had to produce witness statements, documents. So that was possibly the hardest single individual event, and certainly brought home to me how important it is that everything be done properly, because the time and effort consumed, even if you're on the edges of something that's improper, is quite dispiriting, actually.
Very interesting. I always ask about mentors, and I know that you've been a mentor to another guest on this series, Emma Jane Joyce. I'm delighted to actually have you both in the same series together. But I know after a career like yours, you probably can't list all the people who've been influential or been key. And so anything you say here is by definition not an exhaustive list. But was there maybe 1 or 2 key names that really had an impact on your career that you can mention?
Yeah, I had a couple in my business career, probably. My manager in New Zealand in the investment bank, a guy called Keith Sutton, who had the most massive energy, proactivity, always looking for ideas, and the ultimate in enterprising spirit that I referred to earlier on. And I learned so much from him about the value of thinking about things in a proactive sort of way. And my manager for many years in Irish Life Investment Managers was Kevin Murphy, who was a great manager and leader. And Kevin has a high IQ, which isn't necessarily replicable by other people. But what I took from him, he was a very human guy, very interested in how things would impact on human beings. But maybe mostly something that we can all do. He always thought about issues or problems from multiple angles, and that got him to a good answer. So that always got me thinking about stuff from multiple perspectives, and that's great help to get to the answers. The people who've influenced me, I've had some very strong family influences as well. My parents had an amazingly harmonious environment at home. There were never any arguments. So I sort of learned from that in a happy environment, everybody is always willing and able to give of their best. So I've always tried to develop harmonious environments where I've been at work. My wife Una's kept me quite balanced, more than I would have been otherwise, which is really good. And she's also helped me. One of my failings when I was younger, and I'm always trying to deal with it, is overcommitting. And she's very helpful to me to not to overcommit. And I have a son, Hugh, who has an intellectual disability, and he and his pals have got to know his pals well over the years. He's adult now, but it's helped me understand that lots of people have difficulty with things that many others take for granted. And I think that's really important especially going back to diversity and encouraging diversity, but being aware that stuff that I or some people might find easy, there could be others in the same environment who find it difficult to be open to being supportive in those circumstances. So they'd be the sort of things I think which have, both from my business career and family side, which have helped me along the way.
And just my last question is around any advice you might have for your younger self, or any creed or motto that you live by, or any words of wisdom that any of these people have left with you? Is there anything you can share there?
Yeah, well, I've a couple of words of wisdom from public figures. One is particularly relevant in startup or early stage circumstances from Sir Alex Ferguson, who I heard speaking in Dublin about 15 years ago at a dinner, and former manager of Manchester United, incredibly successful over a 30-year period, but was nearly fired for non-achievement after 3 or 4 years at the beginning. And his motto was, he said, it's really important to get scores on the door early on, to buy yourself the time to do the things that you know are right. And I think that was part of the ISIF, making sure that we got transactions done, put a lot of pressure on the team, because we just got to be able to show progress early on. And that then does buy you the time to do the things that you know are long-term and right. And I've also often been taken by a quote from Bill Gates, who says that we invariably overestimate the progress we can make in 1 or 2 years and underestimate the progress we can make in 10 years. And so I think huge change is possible over a 10-year period, but we usually think we can do too much early on, and that never actually happens. Advice to my younger self, I would say one of the most important things I did that was good was that I sort of kept moving, and I moved jobs or moved roles within the same companies multiple times. So this whole idea of rotation, evolution, new experiences worked really well for me. And advice for my younger self, it's maybe an investment advice. And there are times when I and my team could have been braver when market conditions were at extremes, when there's a sort of a runaway train coming at you. And even though your limits, I'm thinking of the tech bubble or, the banks in 2008, we didn't necessarily get out of the way of extremes, which were very apparent at the time because of conventions to do with fund limits and considerations of what peers might have been doing or competitors might have been doing or whatever. So that's probably the biggest lesson looking back, is to be braver when market conditions are at extremes.
Well, thank you so much, Eugene. This has been such a pleasure to have this tour through, as I said, some of Ireland's recent economic history, as well as your own experiences at the helm at such critical junctures, at the helm of the Pension Reserve Fund and the Strategic Investments Fund at such critical junctures. I've always admired you from afar because of your intellectual curiosity, resilience, and balance, the very balance that you focus on when you mentioned those who inspired you. Because I think it was this balance, this level-headedness, this commercial acumen, which meant that we had the best possible leadership at this time. So thank you from the bottom of my heart for that leadership and for sharing your insights here with us.
Thank you, Aoife. I've really enjoyed it. Thank you.
I'm Aoife David. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.